We're diving deep into one of the most powerful trading books of all time, Market Wizards by Jack D. Schwager. These are real traders. Real battles. Real breakthroughs. And the insights we're about to explore might just change how you trade, and how you think. One recurring theme is that failure is all part of finding success. While top traders are considered successful now, they didn't get there overnight. Almost all of them experienced huge setbacks and faced major financial losses. However, they could learn from the mistakes that set them apart. Instead of giving up, they treated failure as a stepping stone. Those who fail and take the time to reflect on their mistakes tend to come back stronger, having bettered themselves. Richard Dennis, for example, famously lost a third of his entire capital in a single day. Instead of being defeated, he honed his strategy, becoming one of the most successful traders. Bruce Kovner reflects on what fellow market wizard Michael Marcus taught him, stating, "You have to be willing to make mistakes regularly, there is nothing wrong with it. Michael taught me about making your best judgment, being wrong, making your next best judgment, being wrong, making your third best judgment, and then doubling your money." So, it's not about avoiding failure altogether but learning to come back from it. What truly differentiates these traders is their mindset. They constantly reviewed their mistakes, adjusted their approaches, and used those experiences as fuel for their future success. So, what can you take away from these traders? Success, particularly in trading, rarely comes without setbacks, but those setbacks provide valuable lessons for those willing to learn. Risk management. Another key theme in Market Wizards is the role of risk management. Every successful trader profiled in the book, no matter how different their strategies or styles, emphasized the importance of having a clear risk management plan. It shows that even though methods for entering and exiting trades may vary, controlling risk is vital for long-term success in trading. Paul Tudor Jones captures this perfectly with his famous quote, "Play great defense, not great offense." The idea here is that protecting your capital is more important than chasing big gains. If you can avoid significant losses, profits will follow when the market is in your favor. It's not about hitting home runs every time but staying in the game by avoiding devastating losses. Risk management looks different for each trader. Bruce Kovner, for example, says, "I know where I'm getting out before I get in." That means for him, setting strict stop losses to limit potential losses is key. Having a clear plan in place helps ensure that one bad trade doesn't wipe out months of hard work. Larry Hite adds to this by saying, "Throughout my financial career, I have continually witnessed examples of other people that I have known being ruined by a failure to respect risk." His point is simple: ignoring risk can lead to financial disaster. If you don't have a firm grasp on how much you're willing to lose, the market will eventually take you out. In trading, success is as much about protecting your downside as it is about making profits. So let me ask you. Do you have a solid risk management structure? There is no one way to trade. Something I've always found fascinating from the book is that there's no single, correct, way to approach the markets. Each trader profiled in the book had wildly different strategies, yet they all found success. This might seem surprising. How could it work out like that? Well, the variety of successful strategies shows that trading is about discovering what works best for you. For example, some traders in the book relied heavily on fundamental analysis, like Market Wizards' Jim Roger. He focused on understanding global macroeconomic trends and used that knowledge to predict market movements. For him, it was the bigger picture that gave him a clear edge in the markets. Meanwhile, traders like Ed Seykota were purely technical. For Seykota, as a market wizard, market price behavior provided all the information he needed. He even used a computer program to trade based on his technical analysis. This contrast between fundamental and technical traders should remind you that both ways can work. There's no one-size-fits-all. Okay, what is the point? Find a strategy that matches your personality, skills, and risk tolerance. Ultimately, the lesson here is that success in the markets is about mastering your chosen method, staying disciplined, and managing risk. Be patient. Patience is one of the most important virtues in trading, and Market Wizards highlights how the most successful traders knew how to wait for the right opportunity. They were never in a rush to make trades, they knew that forcing trades for the sake of being active was a recipe for disaster. As Bruce Kovner wisely said, one of the jobs of a good trader is to imagine alternative scenarios. I try to form many different mental pictures of what the world should be like and wait for one of them to be confirmed. I think this quote shows how crucial patience is in trading. The best opportunities don't come every day, and trying to chase the market can often lead to costly mistakes. Instead, great traders wait until the market presents a clear setup that aligns with their strategy. Jim Rogers, for instance, stressed the importance of staying out of low-probability trades and focusing only on the ones where he had an edge. As he noted, "I wait until the money is lying in the corner, and all I have to do is go over and pick it up." Michael Marcus also reflected on his failure early in his career. "I think I wasn't patient enough to wait for a clearly defined situation." It should be a wake-up call that even experienced traders continually work on their patience. The key takeaway is that trading is not about constant action. It's about carefully selecting trades that meet your criteria and maintaining the discipline to sit on the sidelines when the market isn't offering clear opportunities. Be disciplined. Mastery comes from showing up every day, learning, practicing, and putting in the work. These traders excelled not because they had secret strategies, but because they had the discipline to always follow through on their approach. Richard Dennis gave his statement on it: "You could publish trading rules in the newspaper and no one would follow them. The key is consistency and discipline." He's explaining that it's not just knowledge of a strategy that leads to success, it's the ability to stick with it. The majority of traders fail because they lack the discipline to follow their plan when the market becomes unpredictable. Gary Biefeld adds to this idea by saying, "If you can just learn discipline by using a trend-following system even temporarily, it will increase your odds of being a successful trader." So, even a simple system, when applied with patience and consistency, can lead to better trading outcomes. Another crucial point is that traders who fail often lose sight of their discipline. As the market wizard Tony Saliba points out, when asked why many floor traders fail, he stated, "They think they are bigger than the market. They don't fear the marketplace, and they lose sight of their discipline and the hard work ethic." It's about maintaining respect for the market and staying humble. Traders who believe they can outsmart the market or who stop putting in the effort tend to get blown out as a result. Ultimately, discipline is another key foundation for successful trading. The best traders didn't get there by luck but consistently worked at their craft, honed their skills, and stayed true to their approach day after day. So is your discipline in check? Believe in yourself. Another key trait shared by all the traders in Market Wizards is an unwavering belief in themselves. This confidence wasn't there from the start, it grew as they honed their skills and navigated the ups and downs of the markets. Ultimately, their success was rooted in trusting their own analysis and instincts, even if it meant going against the crowd. Mark Weinstein sums this up pretty perfectly: be your own person. Think against the herd, as they must lose in time. These traders weren't afraid to think independently, often positioning themselves in opposition to the masses. It takes considerable faith to stand alone in the market, but it's another indicator separating great traders from the rest. Larry Hite retold a compelling story about his experience with one of the world's largest coffee traders. This coffee trader couldn't understand how Larry could be successful in coffee trading without deep knowledge of the coffee industry. Larry insisted he knew his system and understood the risk he was willing to take on. He didn't waver, even faced with the opinions of a successful coffee trader who knew the industry inside and out. Instead, he managed his own risk and trusted that his system would perform over time. A few months later, Larry learned that the coffee trader had blown $100 million in the coffee market. It shows that even experts can be wrong, and the importance of trusting yourself, even when others have differing opinion. Be accountable and remove your ego. Safe to say, a lot of traders need to hear this lesson. Successful traders understand that they are solely responsible for the results of their trades, and it's another telling indicator determining those who succeed and those who fail. When traders take full ownership of their decisions, they also find ways to improve themselves and their trading strategies. Larry Hite hit the nail on the head when he said, "I don't trade for excitement, I trade to win. And it really reflects his disciplined approach. Haidt's focus isn't on feeding his ego or chasing thrills, it's on achieving consistent results. By removing the need for excitement or validation, he can make objective decisions that lead to success. The market wizard, Tom Baldwin, adds to this idea: actually, the best traders have no ego. To be a great trader, you have to have a big enough ego only in the sense that you have confidence in yourself. You cannot let ego get in the way of a trade that is a loser, you have to swallow your pride and get out. Baldwin highlights the balance between confidence and the willingness to admit when you're wrong. Traders who let their ego control their decisions often hold on to losing trades too long, refusing to accept mistakes, leading to bigger losses. Marty Schwartz shares a similar thought: when I was able to separate my ego needs from making money, when I was able to accept being wrong, that's when I turned from a loser to a winner. Schwartz has accepted that being wrong wasn't a personal failure. Before this realization, admitting mistakes was more painful than losing money. But by learning to remove his ego from the process, he focused on what truly mattered: making money and improving his trades. Brian Gelber provides a final insight: most traders who fail have large egos and can't admit that they are wrong. So, Gelber, too, observed that a big ego can be a barrier to success. When traders are unwilling to admit mistakes, they cannot learn and grow from them. By accepting responsibility for your trades, good or bad, you open the door to growth, improvement, and ultimately, success in the markets. I want you to ask yourself, do you take accountability for every trade and action you make? You have to love trading. For the traders and market wizards, trading isn't just a job or a hobby, it's a way of life. Their success comes not only from their skills and strategies but also from a deep passion for the markets that drives everything they do. Ed Seykota summed it up as, "I feel my success comes from my love of the markets. I am not a casual trader. It is my life. I have a passion for trading. It is not merely a hobby or even a career choice for me. There is no question that this is what I am supposed to do with my life." You can see Seykota approaches trading with full commitment, a lifelong dedication. I mean, it's what he believes he was meant to do. Tom Baldwin reinforces this idea, stating, "Yes, it's a lot of hard work, you have to love to do it." Baldwin teaches here that only those who truly love the markets can push through the hard work required to become the best. I mean, trading is challenging and filled with ups and downs, but a genuine passion for the process keeps traders motivated to continue learning and growing. It's not about seeing trading merely as a means to make money. Top traders live and breathe the markets with a passion that sets them apart. Do you feel the same way? Thanks for watching. If this helped you rethink your trading psychology, drop a comment below and let me know what you're working on. Don't forget to like, subscribe, and share this video with any trader who needs a mindset reset. Until next time, stay focused, stay disciplined, and remember, the edge is in your mind.